Hi, I'm Winston, and welcome to the Real Estate Template. Today, we're here talking with Zach and Brandon about hard money lending. And I'm going to let them talk about it and explain to you what hard money lending means. Maybe give us a brief definition of it and maybe just help them understand what you do. Maybe tell how the company started, tell how you moved into this area, because y'all moved here from Arizona, right?
Correct.
Okay. So just give a little brief company history, and then let's just get into the nuts and bolts about what it is and how it can help
Absolutely.
people that want to invest that don't have the money.
We can definitely do that. So, Zach Furban, I have been with Capital Fund One since 2018. I got started in real estate back in 2011. I was an asset manager, selling a lot of the foreclosures after the fun times in 2007, 2008, when the banks took everything back. Did that for a number of years until the inventory dried up and the banks had pretty much sold everything off. And then I got into commercial brokerage and was doing just normal buying and selling of commercial residential assets. And in 2018, started in Capital Fund One on the hard money side that we thought the market was going to crash back in 2008, 2019. We were obviously wrong. And so I was trying to be preemptive because I knew that on the hard money side, usually when things go bad, they get busier. And that is very true that we are seeing. So Capital Fund One started back in 2009. We started with a fund about $2 million, and we were loaning at the footsteps of the courthouse back in Arizona. We were in Arizona solely until about 2020. And so we are the number one lender there in Arizona, and we have probably about 55-60% of the market share there on hard money loans. We're the ones doing most of those. Fast forward, when I started with the company, there was about 9 or 10 people, and we have since grown that to about 60 employees, and we are actively moving into new markets. And so we were in Arizona, like I said, for the first 10 years or so, and then August or September of 2020, we opened up an office in Denver, started doing loans there. It started going really well. We're picking up market share there. And then fast forward to the summer of 2021, we opened up in Dallas. And so we were in Texas there, and we just came to the great state of Tennessee about 2 or 3 months ago. And we're excited to get going there.
And our introduction came because Brandon showed up at a meetup that we did.
Yeah.
And introduced himself, and I was impressed with what he had to say. And I said, well, we got a whole group of listeners that need to hear that. They need to hear what y'all talking about.
No, absolutely. During the time that I've been in Capital Fund, I'm, happy to say I've been able to help create scores of millionaires, from guys that were just starting out with fix and flipping, not knowing what to do, being able to offer them the leverage and the capital to be able to grow their business and to be able to grow their portfolios. It's been really fun watching, people start that have no experience to very sophisticated guys that are doing, huge developments and stuff. And so what hard money is, though, is we look at the hard asset. So we are an asset-based lender, meaning we only look at the value of the property. So we don't look at your credit. We don't look at your financials. You could have a 300 credit score. Capital Fund's never going to know. We just look at the value of the house. So anytime you want us to give you terms, you're going to hear a lot of my salesmen saying, send me the details of the deal, because every single deal we look at on a case-by-case basis. We have rough parameters that we can give you, but as far as the leverage goes, or if we're going to do the deal, we need to understand the house or the project of that particular deal.
So if somebody's coming to you looking for some hard money, how much skin in the game do they have to have? How much equity do they have to have?
Sure.
What would qualify somebody for that?
Yep. So generally speaking, these are the leverage tolerances that we abide by. We'll never exceed 75% of the ARV or the future value of the house once the repairs are made.
Okay, so let's address that real quick. What he's talking about is not necessarily what you're paying for the house. I'm sure you're going to look at that too.
We do. Yep.
But you're saying, hey, they got to be 75%, 70% at least of what after they fix it up, the value of it's going to be, because if I'm going to get a loan, they may require 30% down for me to do a cash out refi or something. Right. And if they do that, that doesn't protect you or doesn't give you the ability to release your lien on that note because they can't pull enough money out of it.
Exactly. So that's one marker. We track 4 different metrics. 75% of the future value of the house, 85% of the current value of the house, so what you're buying it for. So let's say you're buying a house that right now is worth $300,000 you're going to put in $25,000 and then you think you're going to be able to sell it for $450. Just as an example. So 75% of the future value of the house, 85% of the current value of the house, 90% of the purchase price, and 85% of total cost. So you plug all those things in there, and I can repeat it anytime you want. But our underwriters take a look at that. You plug those into that formula, you got yourself a good deal. And it's a good thing that for investors to live by as well, too, because there's a lot of hard money lenders potentially that'll give you 100% financing. But if something happens, some of those guys are in the loan to own game. We close about 150 to 300 deals every single month between the 4 states. 65% of that business is repeat business. We could care less about doing one deal with you. We want to build a relationship where you're coming back over and over and over again. And so we're the steady Eddies of the industry. We say we're going to do it, we're going to close on that deal. But you are going to have at least, as I was mentioning, those leverage tolerances, 10 to 20% of your own skin in the game, depending on the deal.
So the difference with you is if you're going to a bank to do what you want to do, number one, it's going to be a big pain in the behind.
100%.
Every bit of it is going to be difficult every step of the way. And they're not going to give you 75% of, they would probably do the 75% on the future value. Mm-hmm. But probably on the present value, I can't see them giving you 85% on the present value. I don't even know if they'd give you 50% if it's a rehab.
Exactly.
I mean, you're gonna struggle to get the money. Then they're gonna require you to have, I don't know, I would say between a 650 and 700 credit score, maybe more than that nowadays because they're tightening all that up too.
Yep.
So if you are somebody that's just, I found a good deal. I'm buying at a 30% discount. I'm buying a house. Okay, if you're buying at a 30% discount, then you are well up below that 85% threshold
for sure
that you're talking about, so they can go buy it if you're buying with that. And I'm sorry, if you're going to buy a rehab and you're not going to make more than 30%,
still don't buy that house.
Just don't do rehab. Get out of the business now before you lose your behind, because it's not going to work.
And you also forgot too, you go to the bank, they're going to want an appraisal. They're going to want to see your firstborn son. They're going to want your credit, your income, the bank statements. You have to wait for the appraisal. And then, like you said, if it's a rehab, they could tell you at the last minute, we're not even doing the deal because, hey, the shower's broken. Where with us, because we're asset-based, you send, Brandon here a contract, current photos of the house, your plan or your line item budget. I'm going to spend $10K on the kitchen. I'm going to put $4,000 into the flooring or paint or whatever. You give that information to Brandon. He's going to be able to close that deal within 24 hours once title's ready. So in addition to not pulling your credit, not waiting for appraisals, not having to wait 30 to 45 days to get the deal done, we have the ability to close as soon as title's ready, assuming that you like the terms that we offer. Because again, it's asset-based. We don't do anything that's owner-occupied. It has to work. We have to be a real estate investor. If you meet those criteria, let's do it.
So how do y'all may say you guys. How do you determine the appraised value?
Sure. So most of our underwriters, all they do all day is look at houses and evaluate them. Some of them are former appraisers, and we do desktop appraisals in-house. So you provide the contract, photos, budget, your experience, if you have any, and our underwriters gather that information up. They pull comps, they look at what's selling in the neighborhood, they, compare it to the current value of the house. They compare it to like, okay, well, hey, he redoes the kitchen, gets the bathrooms, he'll probably get this as a value. And then we, put those numbers together, we send those terms off, and our underwriters, that's all they do all day is evaluate houses.
Do they need to come, so somebody will need to come step on that property and do a walkthrough or not necessarily?
The only time we ever really do walkthroughs on properties is if you're doing major rehabs on multi-million-dollar houses. If you're just sending me a $300,000 house with a cosmetic budget of $20,000-$30,000, we just do that from these. That's why we just ask for current photos.
I think this opens up a door for many of you that are watching this video, because I get countless amounts of people that send me information asking me, how can I get started? How can I do this? I just don't have the money. I don't have the credit score. My income isn't going to show right. I work for cash money. I'm a contractor. Yeah. I don't get paid. A lot of people work in that environment, which I do not suggest that environment by any means. I suggest claim your income, show where you make the money. It's going to help you in the future. You may feel some pain right now from it, but you will eventually do better off by showing your income than not showing your income to the government. There is no purpose to hide it, because when you invest in real estate, you can always use your depreciation to write that income off and not pay any taxes.
Right.
So that is, in my opinion, an extremely good deal. I mean, there's things that if you're going to go out, and even if you got the credit score to do the bank, what kind of origination fees do you charge? Now, origination fees means, what's it going to, let's say we borrow $100,000 on a deal.
Sure.
So what is it going to cost me to close that deal?
Absolutely. So in Tennessee, it varies by state to state. So let's just say Tennessee, for example, your interest rate is going to be 12%. Your origination fee
does that change with the market?
Very unlikely. It depends. That's why, again, because we're a private debt fund, we're not floating with the LIBOR or things like that. Obviously, if a conventional loan goes to 10%, I can't charge a hard money loan at 12. Yeah. But at least for right now, our rates haven't changed since last July when rates shot up. They went from 10.99 to 12%. We went up 1 point. Your conventional loan went up 4. Yeah. So it's very, we're priced accordingly because of the agreement we have with our investors. We know the yield that they're looking for, and so we price it according to that. So 12% on the interest rate here in Tennessee, and for a 12-month loan, it's going to be 1 point or a minimum of $2,000. So if you have a $100,000 loan, it would be a $2,000 fee.
$200,000 loan and still be $2,000 fees.
Exactly. Then once you go over
$300,000, go $3,000.
Exactly.
That's pretty simple math. Now, I know a lot of people are looking at it and say, son of a bitch, I'm not paying 12% for my money. I'm just not going to do it. That's too much. Those people are making too much money. Now, I wouldn't flip a house if I couldn't make, well, personally, I wouldn't do it without 100%, but I definitely wouldn't do anything that made me less than 50%. So I'm going to sit at home eating bonbons on my sofa and not do anything because I don't want to pay you 12%, but I'm going to make 50% off of it, which still yields me 38% return.
Sure.
So I'm going to throw away my 38% return because I don't want to give you an additional, and really when you look at it, the additional money is only a few points right now. It's not a whole lot of money compared to where the market is. I'm not going to give you an additional 3%, 4%, 5% because I don't want to pay that much money. So I bought my first house in the 80s.
Sure.
And I got a 10% interest rate on my first house I bought. That was in 1989. And that was awesome because we were coming out of 17% interest rates nationwide.
Sure.
And in that market, I was excited as hell to be able to get a loan like that. Nowadays, people got used to the 3%, which is, what is that? Nation history, the cheapest we've had.
Yeah.
So they grew up in that market and they scared to death of this 8% market or 9% market or whatever it is. If the numbers work, the numbers work. Do the deal.
Absolutely.
So go ahead. I apologize.
No, you're absolutely right. So why pay us 12%? Well, let's say we write a 12-month loan. Again, keep in mind, we're closing 150 to 300 loans. Right now, we have about 1,700 to 1,800 loans on our books. Our average loan pays off in 5 to 7 months.
Yes.
And so, because again, you're flipping a house, you're trying to get an investment property. We're not the guys you want to marry. We just date you and we have a good time. We get you to the next beat. So you actually pull your calculator out, you realize that,
you only pay a 6% over 6
You're only paying 6, exactly. You're paying 6%.
So it's amortized over a year, which means
and it's interest only.
12% for a year. But if you only use the loan for 6 months, you're going to pay your origination fee of $2,000 or 10%, whichever is more. You're going to pay the origination fee for that. But really, if you do the loan in 6 months and you pay him off, you've only paid 6%. You haven't paid 12% because you're only going to pay for half of the year. And that is a good gig. I mean,
so your financing costs on 6 months with the origination would be $18,000 in interest and $2,000 or $3,000 for the fees. So $21,000 is your financing cost at 80 to 90% leverage, and you just made 50 grand.
And that's on a year?
That's if you in 6 months.
In 6 months?
Because that's it's the middle. So our loans pay out between 5 and 7 months.
Okay.
So we said 6 months for that example.
That's fine. I think real estate investing is a mindset. Mm-hmm. And if your mindset is, I need everything, I'm going to greedy people just kind of irritate me because we got to have that ability. I'm going to do what I do to make money. I mean, that's the purpose of being in business. I get people to tell me all the time, why can't you charge less money? Because I'm not in this for free. I'm in this to feed my family. Well, can't your family already eat? Yeah, they can, but I'm not going to go do another deal if I can't make the same return. It doesn't make sense for me. Why go work the hours to do it? Now, what if that loan needs to go out past? So let's say we go in, and I had a house that I sold last year that took me almost a full year to sell it. So after I built the house, I built it new, and then it took me that long to sell it. I sat on that money for quite some time. Now, what if they go out and they do a rehab? The rehab takes them 7 months. They put it on the market, and it takes them 6 months to sell it. So they're in month number 13. Do y'all have the ability to stretch that out? And how long is the longest you have the ability to stretch it out for?
Brandon, you want to answer that one? Or? So, yeah, every loan that we do comes with a 6-month extension built into that. You have to pay for that extension, but absolutely, our servicing team, month 11 rolls around, hey, Bill saw that your house hasn't paid off just yet. You just wanted to touch base with you. Are you close to selling it? Is it on the market? What's going on? Do you get to run into some hiccups? With us, as long as you communicate with us, 99% of the time, we'll charge you the 1 point to extend that for 6 months. No big deal.
So just a flat 1%?
Yep.
All right, so 1% of whatever the loan cost is. If it's a $200,000 loan, it's going to cost you $2,000. $100,000, it costs you $1,000 to extend it for 6 months.
And then that way, there's you got that safety net baked in there. You got some extra time, and like I said, as long as you're communicating with us, and you didn't tell us, we'll have someone probably do a drive-by inspection, or maybe somebody just check the house out, depending on, again, the current photos that you provide. We ask for another set of photos. The only time people have gotten into trouble with us is just if you told us you were spending $30,000 to fix up the house, and we show up on month 11 and you demoed how the house is going. Yeah. At that point, we won't extend. But as long as you're within the means that you told us, making sense, things are rolling right along. We understand things happen. We understand contractors take longer. The Fed raised rates again, so buyers got a little bit scared right this second. They're going to come. They'll be fine, next month. But this month, you're having a hard time. We get it. Yeah. Like as I said, our whole goal is to get you to come back 100 times. We want to work with you. We're a real estate company, and we operate as real estate investors who loan money. So we get it. We all have, all the senior partners of the company, they have real estate properties. I have real estate properties. I mean, everybody is very much involved in that world. And, again, we're here to help you be successful and provide a product that gets you to the place that you want to go.
So what is your sweet spot number y'all prefer to stay in on hard money loans? You do $1 million?
Absolutely. So our minimum loan amount is $50,000, and we'll go up to $30 million.
Okay.
So
that's a far cry from 2001 and $2 million.
100%.
Which $2 million today don't buy a whole lot anyway.
2 million, so like I said, 2009 we started. We had $2 million that we started with. We now manage around $700 million.
Awesome.
And so this is where investors, and because with a good track record, we have a proven model that was worked. We're not going to be the guy that gives you max leverage. We're going to be the guy that gives you a great, safe deal at a very competitive price. And if you go and shop us around, you'll see we're very competitive. Are there people that beat us? Yeah, but they're also going to try to pull your credit. Maybe they're going to want an appraisal. They can probably close quickly, but there's very few people out there that are going to operate as fast as we do with not as much red tape.
Do y'all do new construction loans?
Absolutely. We love new construction. Our sweet spot, to answer your question, I apologize. We love our bread and butter is fix and flip. So let's say out of the 150 to 300 deals we're doing a month, 75-80% of those deals are fix and flips that pay off in 5 to 7 months. Now, we will look into ground up development. We've done anything from building just one house to doing mini subdivisions, for 30 houses at a time. So again, it just depends on what your timeline is, and if you're willing to work with us. Obviously, on those larger projects, sometimes it does make sense to go through all the headache with the bank to get that done, because it's cheaper. You're getting the headache out of the way, but they're also giving you a lot more leverage, or it's at a cheaper price. But if the name of the game is speed and efficiency, that's what you're paying for with us.
So y'all would do up to $30 million to do a deal. And if the deal's going to be longer in the beginning, say, look, this is a 2-year project. That just needs to be negotiated in the beginning. Exactly. Say, hey, I got a two-year project. Exactly. Just looking at
If it's construction, we will do 18-month loans, but we'll build in 1 or 2 extensions.
Okay.
Just so that way we can keep up to date on it. And then if there's those larger projects, there's a little bit more red tape that comes with it, where we want to, you can't just take the money and don't call us for 12 months. Like, we want to be involved on a monthly basis to understand where things are coming. Our draw process, this is another thing that we failed to talk about, whether it's a $30,000 flip, you want us to hold the money back for draws, or if it's a $25 million development, our draw process takes 3 to 5 business days. You call us on Monday, our draw manager sends you a packet, asking for the lien waivers, showing, what work has been completed. We look at your budget. You request $4,000. We look at your budget. Cool. Flooring was $4,000. Inspector checks it out, says flooring's there. 3 to 5 days, we're sending you the money. There's no bank that does it like that, and that fast.
I am pausing because my mind is going 100 miles an hour.
I'm throwing a lot at you. So
no. I don't do that. I don't do what you're talking about.
Sure.
But yet I got a $1.5 million project I'm fixing to pull out of the ground and build. Mm-hmm. And we pretty much got the cash to do it. But when I throw all that cash at that one deal, then it prevents me from doing 5 other deals that I could do while I'm doing that deal.
Exactly.
And it holds me up on that. We got a 16-unit apartment complex that we were looking at, and I bought 2 neighborhoods last year. So had I not bought the neighborhoods, I had the money to build the apartment complex, but I bought the neighborhoods instead. And so now, in order for me to build that apartment complex, I'm almost in a position I have to. If I'm going to build it right, I'm not almost. If I'm going to build it right now, I got to syndicate it. Mm-hmm. And we were looking at the syndication, but really, to do a syndication, you got to have a goal in there to return 15 to 20% return to the investors.
Right.
And if you can't return 15 to 20% to the investors, you don't want to do that deal, because all you're going to do is tick people off.
Right. Debt is way cheaper than equity.
But this is what you're explaining is cheaper than even bringing investors in.
Right.
As long as I got the percentage to put down on the project.
Exactly.
And what about my land cost? So my land appraisal on that particular piece of land is $1.3 million.
So single family houses, boom, 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 get those done. Makes all those levers I talked about in the beginning. Let's talk construction. Our construction, we loan more at a percentage of your total cost. So we would look at what you bought the land for, what your hard costs are, what your soft costs are, your horizontal, your vertical budgets. We look at all those numbers, we put that together, and we loan somewhere between 65 to 75% of cost. So you buy the land for $1 million, and I got my math. I'm not good at doing math in my head. I can tell you off the calculator, but let's say it this way: you buy the land for $1 million, and your soft costs to get your permits, get everything ready to go, so you can start putting shovels in the ground. Let's say that's $200,000, and then let's say your horizontals everything that goes this way, to get the ground ready to go. Let's say that's $400,000. And then to actually go vertical, which for those that don't know, vertical is what it sounds like. We start building up where you start putting framing in and getting things.
So to clarify a little bit more, so the soft cost is going to be like, I got engineering fees,
permit costs.
I got to get it ready all the way to the point of getting the site ready for construction. Everything that brought me from there to there, not including the price of the land.
Yep.
But all those other costs are you're calling soft costs.
Yep.
Then the horizontal cost is going to be my site work.
Yep.
Getting the site work done. And then once we go vertical means we're going to pour that concrete and we're going up.
Yep.
So that's a good explanation. I think that should clear up a lot of stuff for people.
Absolutely, yeah. So whatever money you have spent to get you to improve the value of the property, that is what we look at, including buying the land, obviously. So let's just say your total cost is $2 million for this deal, and we're going to be a loan amount of somewhere around, let's just say 65% on the conservative side. We can get up to 75 depending on the borrower and their experience, but let's just say 75 or 65%. Our loan would be for $1.3 million. You would spend the first $700,000, and we would finance 100% of what's left.
Okay. I like that. That may actually put me where I'm ready to do that apartment complex by myself and not bring another investor in.
Sure.
Because we can probably hit that number.
Sure.
Fairly easy. Our video guy that he wasn't there the other night when you was there, Brandon, but the guy that does all my videos, he just walked away from a deal because the bank wouldn't give him the money he needed to build the house. And I get people to talk to me about that all the time. And you tell them, call a hard money lending. What's that? So you explain it to them, and they still don't understand what it is. Then you tell them, well, just Google it. There's thousands and thousands of hard money lenders across our nation.
Sure.
But then you call them, and they talk a different language too as you try to talk.
Exactly.
I love the ability to sit and just have a casual conversation with somebody that we can deliver to 150,000 people or 100,000 people, whatever it is, that are all going to see it and say, now I got it.
Sure.
So anything else y'all want to add to that? I have no idea how long we've been doing this, but
No, you're good. No,
I should have put a clock up so I could see when my 30 minutes is up.
No, we appreciate the time, and like I said, we pride ourselves in giving you a fast yes or a fast no. It costs nothing to send Brandon the information for him to plug it in, figure out what the numbers are. We kick something out to you within 24 hours. If you like it, great. If not, it's all good. Call us back next week when you find a new deal. Like you said, there's lots of people out there, but when you actually dive in and look at, how many realtors do you know?
A lot.
A lot. How many conventional lenders do you know?
A lot.
How many hard money lenders do you know?
I've only ever dealt with one.
Yeah.
So now I know two.
Yeah, there you go. So
now I know two. And I don't know the other one. I just dealt with him one time. I couldn't even tell you. Right now we're talking. I can't even tell you what their name was because I don't remember it.
And so like I said, that we stay in our lane. We're a niche business, and like what you were saying, pigs get fat, hogs get slaughtered.
Yep.
So we do what we do. We wanted to have a good product at an affordable price where you're able to come in, work with us 10, 20, 30, 50, 100 times, make the money you're trying to make in an efficient way. But again, we just want you to be a partner with us and have your skin in the game. So will you get better leverage somewhere else potentially? Maybe. But again, are they going to put you through the ringer, ask for all your financials, ask for your money, ask for the appraisals to come back, which if anybody knows and you've been working with stuff, those appraisers aren't very happy right now and they're all over the place. But just to wrap, this up on our side, we love fix and flips. We love short-term loans. We also do have a 30-year option where we can help you get into, if you have rental properties, we can finance those over 30 years through a DSCR loan. If you're familiar with those, it's a debt coverage service ratio. And we also do.
What kind of interest rate are they at?
Those are typically depending on credit. So those ones do have a credit option because, again, you're doing a 30-year loan. Right now, they don't quote me on this one, but they're probably high 7s, low 8s. They're usually between 1 or 2 points higher than a conventional rate, historically speaking.
So you're on track with where the normal banks are?
Just for the long-term loans.
Yeah, just for the long term.
Correct. But one thing with DSCR loans, that they're great for people that are 1099s because, again, the only thing they're qualifying is your credit and then does the property cash flow. So let's say you have, you're a 1099, you make $500,000 a year, but your taxes say you make 100, and so therefore you don't qualify for any loans at the bank. DSCR, you're able to go in there, look at they have good credit, the property cash flows, boom, here's a 30-year loan.
So DSCR, debt service coverage ratio. So if you have a house and it rents for $2,000 a month, and it covers the note that needs to go on the house plus maybe a little bit extra, I'm not sure what y'all do.
We have different outlets to do both. So.
But if it covers the expenses of everything, then they're willing to do the loan, and they don't care about your credit, and they don't care about all the other things because the house itself will cover itself. So that's another good option.
Absolutely. And for those that maybe have bigger portfolios, you'll realize once, I don't know the exact Fannie Mae, Freddie Mae numbers, I think it's 10. You can't have more than 9 or 10 conventional loans. And so as soon as you hit that number with, let's say you're just, you're getting started, you buy a house, you rent it up, you go to the next one, buy a house, fix it up, rent it up, go to the next one. With conventional loans, you can only have 9 or 10 of those, and then the government stops giving you money. So then you have to go DSCR. So then you don't have any other options because you have to find some sort of private hybrid financing because, they'll cap you out at not having enough. So
that is some good information. Brandon, you talk way too much. You talk way too much.
That's my fault.
So Capital Fund 1, that's the name. How can they get in touch with y'all? Now we're going to take, and I'll write everything down, make sure Nick gets everything so that Nick can put it in the bottom. He'll, if you want to give me a business card, he'll post that at the bottom of it. But for anybody watching the video,
talk to Brett. He's the fun one. I just fly around and help people out. He's the one that we working on a daily basis.
Yeah, so what I'll do, I'll give you my cell phone number, and that way if you want to put it in the video, that's how
you don't want to give it to the video? Do you know it?
Yeah, I do know it. So my number is 615-881-4770, and that's how you can reach me. If I don't answer, just shoot me a text message, and I'll get back with you as soon as I can.
So, guys, we're giving y'all some great information to learn. There's some huge knowledge right here. Brandon's going to be at the event we're doing this weekend and talking on Sunday for a little while.
Great.
Zach, you're not going to be here, right?
No, I fly back to Dallas tomorrow.
So but Brandon will be here, and he's gonna present that to the group, and we're gonna do a question and answer session. We can talk about that because I know for a fact that there's a couple of people in there that need to talk to you. For a fact, we know that, and I look forward to being able to take this and bring it to the next level with y'all. I'm excited. I may just do one with y'all so that I can better endorse and say I actually had the experience of dealing with y'all, and just do one. I got a house under construction right now that I got the foundation in, and that's all I got done so far on it. But I'm early enough in it that it's not gonna be a real expensive bill to pull something out and just go do it. Maybe.
Sweet.
We'll talk about it.
Like I said, fast yes, fast no's. Doesn't hurt to call.
Thank y'all very much.
Thank you for your time.
Appreciate y'all.
Appreciate it.
Thank y'all for watching.